NVIDIA up 227% over the last 12 months, and over the last 10 years up a phenomenal 19,327%. Today's episode, we are looking at 5 cheap AI stocks that you must consider buying for the largest gains to outperform NVIDIA over the next 5 to 10 years. Now, bear in mind the AI market is set to become a 1.3 trillion market by 2032, which equivalates to a compounded annual growth rate of 42% over the next 10 years, as well as the fact that the technology spend of each company is to increase from 3% up to 12% over the period. That this is an industry that you need to consider having a sufficient amount in your portfolio. Now, we're going to analyze each one of these companies. We'll look at their historical performance. We'll also jump into their financial metrics. And as always, we're going to go through each one of these companies in the valuation model, getting to not just our intrinsic value, but also our acceptable buy price, given our investor margin of safety, and also explain the upside that Wall Street see over the next 12 months. So jumping straight into stock number 1, now we have Crowdstrike Holdings Incorporated. This is up 147% over the last 12 months. And when we look over the last 5 years, we can see it has increased from around $64, going in an upwards trend over the last few years. It is currently in the upper end of the 52-week range, and it does have a forward PE of around 80.5. Nonetheless, we can see here that Wall Street analysts do consider this one of the strongest buys in the market now, with a score of 4.59 out of 5. Now, when we take a look at some of their financial metrics, what we want to see here is increasing free cash flows year on year. We do note it had negative free cash flow in 2017, negative 163, but since then it has moved in the right direction with increases year on year. Not only are they positive, but we are seeing some very strong growth into FY25 of $5.22, so this isn't something that should be discounted by any investor. Sales growth, they've had some very rapid growth over the last few years. We're talking triple percent digits increases in 2018, 2019. Now, whilst we do see this slow down over the last few years, they are still forecasting strong double-digit growth into FY25 and beyond. Now, for those that like to see it numerically, 50 million worth of sales in 2017. This has increased to 3.06 billion in 2024. So we can see the growth is not stopping with Crowdstrike Holdings over the last few years. One thing we would mention with this stock is the shares outstanding. We can see if you were a shareholder, your position would have been diluted over the last few years due to the nature of those shares increasing. One thing we would say though, over the same period, their share price has returned a fairly decent return. So sometimes worth factoring that as well. In terms of the return on invested capital, what we're looking for here is around 10% or more every single year to give us faith that management are able to effectively allocate their capital. What we're seeing is negative percentage over the last few years, indicating they are yet to make a profit, and we are about to see that now. 2024 though, we do note 0%, and when we take a look at the operating margin, we can see what I would say is a very poor performance. But for these companies that are expanding their top line at a very rapid rate, this does tend to be normal, especially the smaller companies. And what we would say is that the operating margin is moving in the right way. Negative 8% in 2023, 0% in 2024. So we are expecting a profit to be made on the bottom line in FY25. Free cash flow margin, a much better story. In fact, from 2021, some very strong free cash flows in the low 30s, which is phenomenal. We do want to see a minimum of 7%. So the fact that they have blown past this and consistently over the last 4 years is something that does make this very attractive to investors. On top of that, the net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization, shows us the balance sheet strength, essentially telling us over the last few years and expected in FY25, essentially showing us it wouldn't even take them one day to pay off their debt net of cash on hand. So let's jump into the valuation of Crowdstrike Holdings. And as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel, we do deep dives. We run through every single one of these models to get to our intrinsic value. Today's episode, we're going to go straight into the intrinsic value itself. For CRWD, we are getting intrinsic value price of $404. And we can see with the current price at $315.50, there is some nice margin of safety. Now, the way margin of safety works, we start off with 10% and we execute on that if we believe it meets the 3 golden metrics. First one, strong financial metrics. Second one, good forward-looking data. The third one, a wide moat. If not, we keep going till it's near the current trading price so we can see what kind of margin of safety we are looking at. Today's episode, for Crowdstrike holdings, we see between 20 to 25% of the MOS level based on our estimates and judgments. In terms of Wall Street, well, they forecast some very nice upside. As we mentioned earlier, they do believe this to be a strong buy. Price target $396 with a 26% upside over the next year. As always, do let us know your thoughts in the comments below as we do go along these stocks today. The next stock that we are taking a look at is Palo Alto Networks, ticker symbol PANW. Now, over the last year, it is up 38.5%. We have seen it pull back from the highs seen not too long ago, currently trading in the mid to lower end of the 52-week range. Over the last 5 years, very strong performance, up 238%. We see a forward P of around 48.7, and we see Wall Street here indicating it a buy at 4.17. In terms of the financial metrics, well, what we can see, free cash flow per share also growing very strongly. In fact, massive growth from that 2014 23 cents position. And we do know an increase expected into 2024 of $8.82. Sales growth, what I quite like seeing is, yes, they had some very strong growth from 2014 to 2016, but from 2017 onwards, it has been pretty consistent around the mid-20s, and that is expected to continue, which means when we do look at their total sales, a lot of rapid growth over the period. In fact, their top line has increased more than 10 times from $600 million in 2014 to $6.9 billion in 2023. Similar to Crowdstrike holdings, they would have diluted your position over the last 10 years, not as rapidly. And also, again, if the performance isn't that bad over the last 10 years or 5 years, then it isn't massive worry, but something just to keep an eye on, ensure it doesn't get out of hand. ROIC, again, similar to Crowdstrike holdings, they did have a significant portion where they were negative. Nice to note, 2023 at 9%, 2024 or the last trading months, in fact, around 11%, looking decent, and hopefully it does continue to increase. Operating margin also looking positive in the more recent period in 2023 at 6%, on the trailing 12 months at 10%, also looking like we will see an FY24 double digits, which means it's moving in the right direction. Free cash flow margin very strong, between 30 to 45% over the last few years. So again, very strong free cash flows is one of our main criteria when considering companies to invest in, as well as this metric here, the net debt to EBITDA, ideally at 0, and that is what they have produced in 2023, expected in 2024 as well. So again, not even 1 day for them to pay off all of their debt, net of cash on hand. In terms of the valuation then, and also don't forget you can grab a copy of this essential valuation model by clicking on that pinned comment below. And you can run your own companies through this model, companies in your portfolio, companies on your watch list, or even if you want to run through the companies that we have reviewed today. Margin of safety then at 10%, we can see a buy up to 344, at 20% up to 305, at 30%, not quite there yet, but in fact only around $1 shy, not too far off. So we see some significant undervaluation, 30% in fact. In terms of Wall Street, well, their upside, as we mentioned earlier, they do see this as a strong buy, $350, upside of 30%. So we are talking about some high quality companies today with some very nice upside to consider for your portfolio. The next stock to consider, we have Advanced Micro Devices, now up 84% over the last 12 months. Over the last 5 years, some strong growth, up 488%. It is in the midpoint of the 52-week range with a forward PE of 46.75. And again, we have that Wall Street signal of a buy now. In terms of the metrics themselves, well, free cash flow, again, they did suffer some negative free cash flow from 2014 to 2018. Whilst it has increased over the period from 2019 to 2023, we do see very inconsistent increases and decreases. 2024 expected a very sharp increase to, in fact, their highest over the last 10 years at 332. Sales growth, very inconsistent. We do see some years of double-digit negative growth, a lot of years of double-digit positive growth, and in fact, the more recent year, negative 4% to their top line. And when we do look at it numerically, we see it increase around 4 times from $5.5 billion in 2014 to $22.7 in 2023. Again, we are finding a common theme with companies that we are reviewing today. Whilst we love to see companies do share buybacks, return excess cash to investor pockets, we see the opposite, and you can clearly see here that your position would have been diluted over the period. In terms of the return on invested capital, again, pretty inconsistent. We do note a period from 2018 to 2021 where we saw strong double digits to this metric. 2022 and 2023 in the low single digits, something just to keep an eye on quarter to quarter, annual report to annual report, and we will be reviewing those as they do come. Operating margin, again, very similar story to be said here, as well as the free cash flow margin. A lot of inconsistencies. Some periods where it is very, very strong, where we look at and say this is a very strong company, but then we do have periods where it does become flat or negative. So do bear in mind that a lot of these AI companies, there are a lot of inconsistencies year on year. Net debt to EBITDA over the last 5 years, very strong at 0. 2024 expected 0 again. So again, we can say a very strong company with a strong balance sheet, which in fact is the theme of the companies we are reviewing today. They all have some very strong balance sheets, which is a plus as an investor. In terms of the valuation of AMD, intrinsic value is arriving at $212, and our current price of $170 makes us take a look at the margin of safety. 10% a buy up to $191, 15% up to $180, 20% up to $170, so pretty much bang on right now a 20% MOS level based on our estimates and judgments. When we take a look at Wall Street's forecast, well, they have a price target of $202. They see this upside of 19%. Again, similar to Crowdstrike Holdings, similar to Palo Alto Networks, and this AMD is showing another strong buy now. The next AI stock that we are taking a look at is Adobe. Now, this is up 27% over the last 12 months, and even though it is up very strong, it is in fact to the midpoint of the 52-week range. The forward PE is looking at just under 27, and again, similar, we are seeing a buy signal for Wall Street. Over the last 5 years, we can see this stock has been on a bit of a roller coaster. However, it is up around 81%. In terms of the free cash flow, pretty much as consistent growth as we're going to get with these companies. $229 in 2014, $15.20 in 2023, expected to go higher in 2024 up to $19.80. Sales growth, very inconsistent but very strong nonetheless. We are seeing double-digit growth to their top line every year, bar 2014, which was the furthest year away. So that is a very positive sign. Does make you understand when you look at that consistency what to expect for future growth. Total sales increased very sharply from 4.15 billion to 19.4. And when we look at the shares outstanding, the first company today that actually do share buybacks, which is very positive. Remember, as these companies are buying more and more shares outstanding, it does give you a larger ownership of the company. In terms of the ROIC, finally, we have a very strong company with a strong, healthy ROIC metric, and it is increasing over the last 10 years. The last 3 years in the 30s as well. Very, very strong. Does give me faith as well when I am looking at this in terms of management. Operating efficiencies, very strong sign here. Operating margin increasing 10% in 2014, 34% in 2023. And the free cash flow margin pretty much as good as you're going to get for the majority of companies in the S&P 500. We are looking at some very, very healthy numbers in the high 30s and low 40s. Net debt to EBITDA, again, pretty much zero nearly every single year. So another company with a phenomenal balance sheet. No worries with it whatsoever. So in terms of the valuation for Adobe stock today, let's get to it. And it is arriving at an average of these two models at $636. Now, with a current price of $485, a 10% MOS level would indicate a buy at $573. At 20%, it would indicate a buy at $509. And at 30%, it isn't quite there yet. When we go to 25%, isn't too far off for 25%. So for today's episode of Adobe, we would say between a 20 to 25% margin of safety. What about Wall Street? Well, $618 as their price target over the period, with 27% what they believe will be the upside if you were to invest at today's value. As always, do drop your thoughts in the comments below. Now, just to let you know, we have released our latest free weekly article where we do discuss undervalued dividend stocks. We've run through 10 undervalued stocks based on dividend yield theory, completely free. Click on that pinned comment below to sign up. You also get free instant access to all of our other articles, which we do release every single week. Now, you could argue we have left the best stock to last. It is Snowflake Incorporated. It is up 5% over the last year. Over the last 5 years, well, we can see, in fact, in 2020, it was trading at $254. It did hit all-time highs of around $400 at the back end of 2021. And positively, it is towards the 52-week low. I know a lot of investors do like to buy stocks near that range. Forward PE sitting at 161, very expensive, so we will take a look at what metrics are offered for this PE. And we do see Wall Street again indicating this as a buy. So in terms of the free cash flow, well, nice to note that it is showing free cash flow positive, and we can see over the last few years it has been increasing year on year. FY25 expected more of the same. When we take a look at the sales growth, well, some very strong triple-digit growth to their top line from 2020 to 2022. Even though it has slowed down, FY24 still showing some strong growth, and looking at their latest investor presentation, they do believe that top-line double-digit growth will continue. Total sales then, 100 million was what they reported in 2019. FY24, 2.81 billion. So they again have had some massive growth over the period. And also similar, bar Adobe in today's episode. Again, this is another company that would have diluted your position over the last few years. In terms of the ROIC, again, they haven't yet made a profit, hence why we are seeing negative ROIC, and again, that can be confirmed by the operating margin being negative. The only positive to say here is that it is getting better and better year on year, and hopefully in FY25 or FY26, at the latest, we do see them turn a profit. Free cash flow margin a lot better. Whilst it was negative in 2022 and beyond, we do see some very strong growth. 24%, 27% free cash flow margin is very healthy, and if that does continue, then again, a very strong company to consider for the portfolio. Net debt to EBITDA, the last 3 years, 0.25, expected 0 as well. Again, another company that is giving a very strong balance sheet to investors. In terms of the analysis, and again, that is really important. Just because you are looking at a very strong company, it doesn't mean you buy it straight away. You have to analyze, see what the margin of safety is, and whether or not it is a company for you to execute on today. Intrinsic value then, $227. With a margin of safety at 10%, we can see a buy up to $204. 15% 192, 20 at 181, and we can say this has a fair number of margin of safety, not at 35% just yet, so between 30 to 35%. It has come down in the more recent period, hence why we are seeing a larger margin of safety than we did previously review this company. In terms of Wall Street, well, they believe this is a strong buy now. We have upside of 42%. They have a price target of $218. So out of all the companies, whilst we have seen a lot of stocks on today's episode between 30 to 40% upside, this is the one that they do believe to be the one that you should really consider for the portfolio. As always, do let us know your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget as well, you can grab a copy of this valuation model by clicking on that pinned comment below, where you can get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio and on your watch list. As always, have a great day. See you on the next episode, and for now, take care.